How to spot a recession. Most economists only see a recession in the rearview mirror after it's already started. Although some economists watch the equity markets, and every swoon in the equity market, they're worried about a recession, and then it rarely happens. And then, of course, there's the inverted yield curve. It is a superb measure of future recessions, but it has a real big problem: timing. When the yield curve inverts, short-term rates higher than long-term bond yields, it can mean a recession is coming in 6 months, 12 months, maybe 2 years. And if rate policies change in that time, the recession may not occur at all. That's what's happened in the US, by the way. The Fed's changed direction, so the yield curve may not be even signaling a recession's coming. So what do we look at for shorter term indicators? One of the best ones is to look at high yield debt. Now, if you think about high yield debt, it's often viewed as an option. So if you own a stock, it's like owning a call option on the assets of the company. The stock goes up, the call option goes up. If you own debt, it's like owning a put option on the assets of a company. So if the company goes south and is not making money anymore, the high yield debt interest rate is going to go up. So when high yield debt interest rates go up, your put option is losing money, the debt's not doing well, and it's a signal a recession could be coming. So we watch high yield debt spreads against government bond spreads, but they have to rise significantly. A small rise in high yield debt interest rates is no big deal, but a big rise, watch out. Now, people also look at the jobs market. All recessions have a lot of job losses. The thing about it is that companies get in trouble, they're not making money, and then they cut jobs. So jobs are a lagging indicator. But if you are looking at jobs and you're thinking about a US recession, you can watch the weekly new unemployment claims. That's the most recent data. And by the way, if a recession happens, that data turns south really fast. You will know it in just 3 or 4 or 5 weeks because it just gets worse and worse and worse. So that's what we watch. First the high yield bonds, then we watch the jobs. And hopefully we can see this before it's coming. I'm Blue Putnam, Chief Economist, CME Group.